Good morning from our global headquarters in New York. I'm Menace Cranny. It is Bloomberg Brief. Let's set that agenda. A global crisis of confidence and in growth, and the Fed stokes a dramatic repricing of rates. Traders now betting a 60% chance of an emergency Fed cut within a week. A tech implosion. Nasdaq futures rebound from a 6.5% drop after entering a technical correction on Friday. This as Berkshire Hathaway bails on Apple. And the yen rally intensifies as carry trades unwind. JGBs fall the most since 1999 as the Topix enters a bear market territory. A very good morning to you. What you have is a crisis of confidence manifest in the growth story and the Fed, and that takes your cross global equity narrative lower. Nowhere more visceral has it been than in Japan as the yen rallies. But to the Nasdaq, down 3.8%, we had dropped by nearly 6.5% at one juncture. We're now at such a tipping point of where fear is overcoming greed that the market is now pricing in a 60% chance of a 25 basis point, that is an intra-Fed cut. 60% possibility of an intra-Fed cut. Apple is down 7.6%. Berkshire Hathaway guts their position in Apple by 50%. The last time, I should just put some context around this, SPOOs are down 2.4%. The last time you had an intra-Fed meeting cut was in March 2020 in COVID. It was a total of 150 basis points with QE. So the narrative has pivoted very aggressively from no landing to a hard landing very aggressively. Nvidia is down 20% from its peak. The question you must debate for equities is whether this is an air pocket and an opportunity or something much more toxic than that. To the bond market, let me show you what's going on there. 10-year government bonds dropped by over 40 basis points last week, but the short end of the curve, you haven't seen this scale of repricing. Just to put some context around it, down another 7 basis points this morning. That is down a total of more than 60 basis points in 6 trading sessions. This is the fastest implosion of the short end of the curve behind headline rates since 2008. This is a hellish hard landing the bond market is going for. You might be bullish on bonds, but these are nervous bulls on the bonds, and the yen and Swiss, the haven status of those currencies, is affirmed in totality. How long will that endure? Peter Kinsella is my guest this morning, Global Head of FX Strategy at Bancaire Privée. Peter, good morning to you. Good to have you with me. As you look at these markets, you could be forgiven for saying there's a sense of mania, there is a sense of panic in terms of the growth confidence and the Fed being behind the curve. How manic a Monday is it for you?
Yeah, look, it's as manic a Monday as they get. The last time I saw these type of moves, in dollar yen was pretty much in 2008, in terms of the speed and magnitude and breadth that we're seeing. So it's a manic Monday, no question about it. What we've seen certainly in dollar yen, I think last week was really interesting in the sense that with the BOJ obviously raising rates, engaging in aggressive sort of tapering of its QE program. But I think the fact that the BOJ said they were likely to raise rates again in the subsequent meetings pretty much indicates that the BOJ believes that sort of growth potential in Japan is probably a lot higher than many had anticipated before. And then obviously we've seen a very aggressive sort of rewind in carry trades, people getting out of long positions in Mex and Brazil and others. And likewise, you're seeing dollar yen pretty much fall like a stone. We've gone in the space of 2 weeks from 161 all the way down to sort of 142 as of this morning. So it's a very, very aggressive move, mainly a short covering move. And I think if we look at sort of the broader dollar, really what we're starting to see, obviously dollar weakness against the safe haven currencies such as yen and the franc, we're now likely to see that sort of widen and broaden, and I think certainly we're likely to see the dollar weakening in a more directional manner against the likes of the euro, sterling, and so on. So it's really a case where we're seeing the first leg against safe haven currencies, and next against some of the other majors in G10, and thereafter we'll have to see what the Fed's doing.
Okay, let's just put a pause in there because there's a lot to unpack. Let's start with the narrative. The market is now vaulted from, on Friday morning when I started this show, I said there was a nano chance of an intra-Fed rate cut. Now, the last time we had an intra-Fed rate cut was in March. It was in the March 2020. It was in the eye of COVID. It was 150 basis points. Differentiate for me now between COVID 150 basis point cut in March 2020 and now the baying call for an intra-Fed cut, 60% probability. Do you agree that it could come? And if so, what size and scale?
Okay, do I agree whether it will come? I would say probably not. I think that it's unlikely in my view. What we're seeing at present is quite simply, it's not, what we're seeing in COVID. It's not a crisis. It's simply a business cycle, right? And I think the moves you've seen overnight in Japan likely exacerbated by very poor liquidity. Let's not forget that. And certainly if the Fed simply signals that it's likely to cut rates aggressively in the coming months, that should do the trick. They don't necessarily need to cut rates this week, as it were. So I'm not yet in the camp where we'll see an aggressive rate cut, intra-meeting cut. I think that would be really sending panic signals to the market.
And by the way, the first intra-Fed meeting cut in March 2020, Peter, invoked a drop of 3% in the S&P 500 and rates to go 1%. So it was a crisis response mechanism that we saw there. OK, let's move it forward. So the Fed have got to jawbone the market to create the floor, as it were. I haven't seen, I mean, if you think about dollar yen, it was parabolic on the way up, Peter, wasn't it, in terms of the dollars a cent? Here it is. It's almost like a bottomless pit at the moment. And I want to clarify from you, if you say leg one is short covering, do we go towards a capitulation move of where we trade through? The next leg is to trade through the 140 level and over 142.40 at the moment. So is the next leg, if we are genuinely in a growth slowdown phase, a business cycle growth slowdown phase, do we continue to buy yen, or is the alternative to buy Swiss and perhaps do some more unwinding of the carry?
I think it's likely, yeah. I think we'll go through once, getting a move below 140 is definitely feasible. I mean, if we look at dollar yen, a fair value in dollar yen, probably closer to 120-ish, maybe 125. So there's definitely more juice in the trade. I think the move we've seen thus far is really positioning shift. But if we look at it in terms of monetary drivers, that will be the next leg. And certainly with a slightly higher rate from the BOJ and indeed lower rates from the Fed, that's likely to push dollar yen that little bit lower. I think that down move will certainly be less volatile than we've seen and less abrupt. But nonetheless, I think the direction of travel is lower. The carry trade really that we've seen in the last several years, it's burst. Many of us for a very long time were saying that yen was absurdly cheap. And certainly that's now unwound. And this process is going to be a multi-month process. It's not going to be something that's done and dusted in a week, I'm afraid.
What do you get from the Fed this week? Is it a jawboning?
Oh, yeah, I would think so. I think if they were to cut this week, in an intra-meeting cut, it would really signal panic stations from my perspective. So I think that's just a step too far. But certainly, moving towards, the Jackson Hole Symposium at the end of the month, I would anticipate we'll get very strong signaling from the Fed, at which they say, look, September, done deal. Consider 50, and then perhaps we'll see how we go from there. But an intra-meeting cut at this point, we're not dealing with a pandemic. We're dealing with a simple reversal of a business cycle. And so, to my mind, an intra-meeting cut would be unjustified.
Yeah, well, as I say, in March 2020, the first response mechanism was to crash bond yields and equities. The second move, of course, put a floor under it, Peter, that cut up 100 basis points. Does this give then additional drumbeat to the doves on the Bank of England and within the ECB? I'm just looking at euro sterling at the moment. She's flying higher, cable's a little bit lower, nothing too dramatic, down by 1/3 of 1%. I think that's got a touch of geopolitics in it as well. A reality check for Keir Starmer on the finances and one thing and another. Down 1/3 of 1% is where we are on cable. Does this kind of mania of risk off, which is how I would describe the equity market and the bond market, Peter, is quite literally fraught this morning. I would say bullish, but fraught. Does it add to the narrative of cuts for the ECB and the BOE?
I would say it does. Look, I mean, where the Fed goes, the others follow, right? And certainly vis-a-vis, the BOE in particular, if you've got a very close business cycle, what you tend to find is that their respective rate moves move pretty much in tandem, albeit with small lags. I think from the BOE's perspective, that they could have remained on hold last week, and in a sense, the Fed should have cut, right? So, they basically, we could have seen a role reversal there. But nonetheless, I think if we look at the BOE, they've signaled they're going to continue cutting rates. 5-year swaps in the UK at around 3.7, 3.6%. So it kind of tells me we're likely to get a front-loaded rate cutting cycle here in the UK. I think 100 basis points in the next 6 to 9 months is feasible for the BOE. I don't think they're going to do a lot more than that. Certainly that was the message we got from Haskell, from the BOE's Haskell. So overall, look, I think that we can anticipate further rate cuts from the majors. It's a question of speed and timing, of course. But as I said, look, where the Fed goes, others will follow.
Well, Suzuki was on the tape this morning, and again, I think we're possibly, for whatever parabolic moves you had on the upside, I think they're going to be uncomfortable as well with the velocity of the strength. Peter, thank you very much for the context this Monday morning. Peter Kinsella there, Union Bancaire, Privée. Other stories trending on your Bloomberg terminal this Monday morning. L'Oréal is buying 10% of Galderma. Now, this is a Swiss maker of injectable skin fillers. The stake, which has a market value of nearly $2 billion, the French beauty company agreed to form a specific partnership with Galderma to create a new skincare product to reduce the signs of aging, while a recent boom in skincare cools. Vice President Kamala Harris has met with at least 3 possible running mates on Sunday. The shortlist included Arizona Senator Mark Kelly, Pennsylvania Governor Josh Shapiro, Minnesota Governor Tim Walz, and others who Harris didn't speak with in person, according to people familiar with her plans. CrowdStrike says the leadership of Delta failed to respond to an offer for assistance in the wake of last month's catastrophic global system failure that led to thousands of cancelled flights. Delta didn't respond to CrowdStrike's letter, but flagged an earlier reference to taking legal action related to lost revenue, compensation to passengers, and reputational impact. Okay, this sell-off is quite brutal on the equity market. We've got money flowing into bonds at quite a pace. But this is the crypto world. Bitcoin down 11%. We dropped as much as 14% at one juncture. And that's rippling across the family of crypto. It's one of the worst drops we've seen since March 2021. Now, it's the biggest weekly fall, by the way, since the FTX crisis. We're seeing money flow out of these funds, which takes us to the exchanges, all under pressure this morning. Coinbase coming back from its a little bit of a worse drop, down 11.3% at the moment. But perhaps the most brutal of all is Marathon there, down 14.6%, followed by CleanSpot. That is your crypto spillover on this risk-off Monday. Coming up, bad news is piling up in mega cap tech. We put some context around the tech sell-off. And later this hour, we speak to Freedom Capital's Jay Woods on the intensifying global sell-off. Context matters every day on Bloomberg. Bloomberg Brief this Monday morning, live from New York. It's been a brutal risk-off across all markets, but especially in tech. Nasdaq futures, the rebounding. I mean, we had dropped as much as 6.5%. That's after the index entered a correction on Friday. As you can see, we have a drop in NVIDIA of over 9%. Berkshire Hathaway has, it's got Warren Buffett bailing on Apple. Let's take the broader theme to Tom McKenzie. Tom, I'm looking at what Julian Emanuel is writing about these markets from Evercore this morning. Corrections are normal in bull markets. They're called air pockets. And they happened often in the internet boom of 1995 to 2000. 2024's AI air pocket is an opportunity to gain exposure in the long run. Well, I tell you what, if you're sitting long of NVIDIA this morning, you might not just see it as an air pocket. It's down 20% from its highs.
Yeah.
How brutal is this? What's the feeling at home in London?
Yeah, and look, comparisons with the dot-com bubble send shivers down the spines of many, of course, and there's the pushback from those who remain constructive on this whole AI theme, saying the fundamentals are very different. And it's interesting to reflect on what we heard from the CEOs last week in terms of on the earnings front, whether it was from Meta or Amazon or Microsoft. One of the reasons why those stocks were challenged and the narrative was challenged precisely because they continue to reiterate they will continue to spend on AI hardware, of which Nvidia, of course, remains a key beneficiary. Nonetheless, as you're saying, they're pointing to significant additional losses today. Across the market, then, you are in correction territory right now for the Nasdaq 100. The drop of more than 10% then since the record highs of July. You talked about the fact that we were close to that circuit break level now. We're far away from that, it seems, right now, but still pointing to considerable losses. The Asian session was pronounced in terms of the losses that came through. Yeah. The banking space was hit, but also the semiconductors. Think of TSMC. The biggest drop that came through there in terms of the market drop for the TAIEX, and TSMC was central to that. The biggest drop, the worst day for the Taiwanese market since 1967, Manus. So this is concerned the valuation risk, concentration risk, politics as well as we lead up to that election, of course, in November. And all of this coming together to provide these headwinds for this sector.
I'll give you a clue, Tom. 1967 was a pretty vintage year. Some pretty important people were born that year. If you look at SPLC, you can restrain yourself now. You look at SPLC, the supply chain around Apple, Tom. It plays to that narrative. The biggest suppliers into Apple also under pressure. Taiwan Semiconductors, Murata Manufacturing, all of these play into the Apple, which then takes us back to the story of Berkshire Hathaway bailing on or gutting their position on Apple. Put that in context for us, because he's not exactly bailing on Apple completely, but it's called a material change in exposure.
Well, the timing is consequential, isn't it? There's no evidence that Warren Buffett or Berkshire Hathaway timed this, of course, to align with the drop that we've seen in the markets. But in terms of, for those investors looking for fear around every corner, this is a further concern. We don't know the rationale. Look, this could be around rebalancing the portfolio. It could be around risk management. To your point, this remains the largest single holding for Berkshire Hathaway. It remains the largest single holding. They've been exposed to Apple since 2016. They've seen an upside in terms of the shares since then of around 900%. So they remain sitting pretty. But this was a big sell down, $75 billion or so from around $140 billion. So their holding remains at around $85 billion. Or so. So it's a significant sell down. Does it suggest that Warren Buffett is seeing concerns? Is it suggesting that he's seeing concerns in terms of the health of the US economy? Is it a further risk radar move in terms of anyone who's betting on a recession now in the US? Or is it just rebalancing because it has such a sizable hold within that portfolio? That debate, of course, continues. But bad news in terms of Apple. Wedbush, by the way, Dan Ives saying, look, the fundamentals are still there for Apple. We're looking at that upgrade cycle with AI coming to the fore. That's one view, at least, from Dan Ives.
Tom, thank you very much. Tom McKenzie there with the very latest on the sell-off in technology and the Apple story. Look, the butterfly flapped its wings in America on Friday, and it was reverberated globally. Look at what the topics and the Nikkei have done. The velocity of the sell-off here, it cannot be understated. I've had a variety of people messaging on this. So it really is a brutal sell-off in topics and in the Nikkei. And the consequence across the currencies, you've had an unwind in the carry trade. We've just had Peter Kinsella there say he wouldn't be surprised to see a break of 140. We've short covering to this level. The next leg is actually buying yen. Some front page news for you now this Monday morning. There are other headlines around the world. First up on the cover of the Journal, and the FT and others, it is the global red, the Nikkei, the Stock 600. Stocks around the world are plunging. The VIX futures climbing above 40 points, indicating Wall Street expects more market turbulence. Washington Post has another story on papers around the world about how Israel is bracing for retaliation after Iran calls the killing of Hamas's top political leader in Tehran a mistake. Let's take that story. Let's get to Jumana Basetchi. She's our host of Middle East and Africa Horizon. Jumana, the world is on tenterhooks to see what the reaction function is from Iran towards Israel. Of course, we've seen the color of that kind of response mechanism earlier this year. So where are we in terms of that? What narrative are we hearing from Iran on the potential for a response to Israel on the attacks that they made last week?
Well, it certainly feels like a retaliation is nigh. The U.S. Secretary of State Antony Blinken had a call with his counterparts, other G7 foreign ministers over the weekend. Axios reporting that he told them to expect a retaliatory attack on Israel by Iran and its proxies in the next 24 hours. And indeed, the U.S. Central Command officer is in the region. The U.S. is deploying extra military warships, fighter jets to the region as well in anticipation of this potential response. And equally, you hear of airlines canceling flights into and out of Tel Aviv and Beirut. The embassies in Lebanon advising their citizens to leave the country, including the likes of U.S., U.K., Australia, and some of the Middle Eastern countries as well, Saudi Arabia and Turkey. This as the Iranian Foreign Ministry this morning put out a statement saying that Iran will take serious measures to create necessary deterrence. So the question here, Manas, is are they looking to create an escalatory stance or to create deterrence? And that is the one that will be answered in the next coming days.
Yeah, well, we just look back to April when there was those 300 projectiles sent into Israel. Most of them were brought down, and Biden calling for a hostage deal that needs to get done. Jemana, thank you very much. Markets are moving risk off in equities. Money flows into the bond market. You are looking at some of the biggest sell-offs that we've seen. Now, we're bouncing from the lows. We're down 6.5% on the Nasdaq at one juncture. Money is flowing into the bond market, as I say to you, and the risk of an intra-Fed cut coming, according to Peter Kinsella, Bancaire, Privée. He sees it as being low. This is not 2008. Bancaire, Privée. From our global headquarters in New York, I'm Manus Cranny. Let's set your agenda. A global crisis of confidence in growth and the Fed stokes a dramatic repricing of rates. Traders now bet a 60% chance of an emergency Fed cut within a week. A tech implosion. Nasdaq futures rebound from a drop of 6.5% after entering a technical correction on Friday. This as Berkshire Hathaway bails on Apple. And the yen rally intensifies as carry trades unwind. JGBs fall the most since 1999 as the Topix enters a bear market. A very good morning to you. How do you feel this Monday morning? There has been definitely not just a growth scare, consideration of the Psalm rule. Should the Fed be cutting rates? They're behind the curve. This is a growth scare, and this is a concern about central banks being behind the curve. The Nasdaq down 4%. It was down as much as 6.5% at one juncture this morning. The narrative is building that the Fed may need to do an inter-meeting cut. The probability of that stands at 60%. This time on Friday, I said to you it was a nano possibility. It's now morphing into a market narrative. March 2020 is your benchmark. 150 basis points of cuts in March 2020. We are not in March 2020. This is not COVID. This is not GFC. JP Morgan and Citi call for 50 basis points of cut. You've got the SPOOs down 2.4%. Berkshire Hathaway guts their position in Apple's cutting their position in Apple by 50%. So you are just seeing Apple under pressure. The whole of the tech sector is taking a real hit this morning. The supply chain into Apple as well. Nvidia's down 20% from its peak. Julian Emmanuel, soothsayer to the market. This is nothing but an air pocket. We've had plenty of them between 1995 and 2000. It was a tough 2000. But is it an air pocket or something more malevolent? Roll it over, have a look at the bond markets. You have seen a crushing of yields. In actual fact, yields rates are acting much more of a haven basis than in the period of SVB. And this is critically important. By the way, the short end is moving lower again. That is an acceleration down in yields in the past 30 minutes. We're going for a hellish hard landing. That is what the bond market is telling you. Havens are bid, yen is up, dollar is down, Swiss is up, dollar is down. And this is leg one of that move, according to Bancaire, Privée. There will be no intra-Fed cut from them, according to Bancaire, Privée. Let's get to our reporter, Justina Lee. She joins me now. Obviously, Asia has had a brutal sell-off on the Topix and on the Nikkei and a strengthening in the yen. Just talk me through, Justina, good to see you this morning, the intensity of this sell-off and just how pervasive it has been.
Yeah, it's pretty incredible how we so quickly went from, bad news is good news to bad news is bad news. And I think it goes back to the job market kind of last week, where we kind of got a bit more indication that perhaps the U.S. is headed for a recession. But I think the intensity of this sell-off kind of speaks to how stretched the soft landing trades were, because people were pretty confident that was happening. So they were putting on carry trades, selling volatility, buying tech stocks regardless of valuations. And now we're kind of seeing a lot of that unwind. And a lot of the time you get that reflexivity in markets. And I think that's in full display today.
Justina, thank you very much for putting some context around that for us. Let's bring in Jay Woods, Chief Global Strategist for Freedom Capital Markets. How are you doing? This is a rough Monday morning to come into. We were all hoping for a little bit of short covering. How tenuous is this in your perspective?
Yeah, we didn't need these Japanese headwinds on top of what happened last week after the unemployment numbers. So this is one of those things where when you live through it, you got to put it into perspective, and that's what we're trying to do. We're in the midst of a correction, 10% down in the NASDAQ 100, going to be a little lower today. You get your shopping list out. You want to look at where the opportunities are, because this is August, September, historically, 2 worst months. We've been down the last 3, August and September's last 3 years. So this is kind of normal. These are seasonal headwinds accelerated with some big headlines, some geopolitical concerns. You mentioned before this, the tensions in Israel, and then an election season. So the headlines are going to really make us focus on this sell-off. But as someone looking at the fundamentals and the patterns, this is a buying opportunity, and one that when you go through it, you don't want to, you don't enjoy this. But when you put it into perspective, I think we're going to be okay.
Can I challenge you a little bit? Because I just don't feel that this is a kind of normal August at all. I have rarely lived through 43 basis points drop. I mean, my worst margin call in bonds was in 1994. I haven't seen twos drop by 60-odd basis points in this space of time. What's the bond market telling me that the equity market is barely catching up?
Well, the bond market is moving at a ridiculously rapid pace. So it's telling us, one, that the Fed messed up last week. They should have cut. That was the biggest problem. And then you get that unemployment data. Now, it was a little skewed. No one talks about Hurricane Beryl adding to that unemployment on the temporary side. But yes, we're still coming off historically low unemployment, 3.4% to 4.3%. You tell me 10 years ago we're at 4.3% unemployment. All right, life is good. Inflation is dropping down to 2%. So step back. Let's look at it. Yes. Somme rule. Is that where you're about to go?
I was just about to say, where are you? Because the Somme rule has been a fairly prescient indicator of tougher times to come. I suppose the question is this. Yeah. If it's not GFs, so let's just lay out the framework. So 6.5% drop in the NASDAQ this morning. Bonds down by 60 basis points in the space of a week, the short end of the curve. So the context is this. This is not GFC. This is not a pandemic. This is potentially... Now the markets are saying to me something more than a soft landing. That's what these markets are telling me. So what does that do to risk in your view?
Well, I mean, I think you want to look for opportunities. So I think this is still a risk-on environment. I think this is a long-term secular bull market. And given these headlines, given what's going on, go back to perspective. That is the most important thing. Yes, the Somme rule was triggered, but that was created in 2019. Even Claudia Somme, the author, said that this time could be different. It is statistically proven to be the best indicator, but so were 2 negative quarters of GDP. We had that. Nothing happened. We had the yield curve has been inverted for the longest time. So I think this time may be different. Wake up to this morning, you don't feel it. When you look at the fundamentals, I worry about the story out in NVIDIA today.
I mean, down 20% from its peak. That's now technically in a bear market. You've gone through correction. It went like that.
Well, we had a 20% correction March, April in NVIDIA, and then we had a correction last August 24th. They had the best earnings
so
ever.
This is an air pocket. You're with Julian Emmanuel. You're going for lunch, and the two of you are rubbing hands, and you're going to an air pocket. It's an air pocket.
It is, and look at this 95 level technically in NVIDIA, and you have what you consider an opportunity. People have been waiting for this. Oh, when can I get in? When can I get in? When it happens, that's when you get scared. So this is, through experience, you learn that over the long term, these are great opportunities. Will it be the low today? No. But this is an opportunity where you get your checklist out and you put in some low ball bids, and maybe you get lucky, and maybe you end up looking at your positions. You know who's happy today?
Go on.
Warren Buffett. He's very happy today. They have the most cash on the sidelines. You think he's just going to sit there and watch this and do nothing? No. He's getting ready to go shopping. And that Apple position, he had 50% of his stake in Berkshire was Apple. He had to cut it back. I didn't think it would be this dramatic, but it's something to watch.
It's interesting because, we have had Nancy Tengler in the seat, and she said, not owning NVIDIA is a bit like having a root canal without Novocaine. And here we are. You look at some of these drops, and you say to yourself, look, the world isn't stopping. We're not going to not buy iPhones.
Yeah.
Companies are not going to AI-atize. They're not going to not spend. And so, therefore, that's when the flow of money comes in. But then let's just take it to the small caps. Danny's not here. Homage to Danny. She'll be on surveillance in a while. And you can be pretty sure she's going to be talking about small caps there. But you've had this great run-up in Russell through July. It was the best outperformance by small caps to big caps since 2001. I've got to reprice that now.
You do.
I know we've already begun to reprice it, but do I more dramatically reprice that?
Well, the Russell has been the most dramatic mover. When it rallies, it rallied 27% from October to December last year. It had a rally of almost 20%. It almost eclipsed the NASDAQ 100. Last Wednesday, we were talking about it being the leader of the indices. So the Russell is super sensitive to these moves. It was a rotational move. We saw people get rid of their winners. They went into the losers. They looked for opportunity. They went to the Russell. Well, that rotation trade is now over, and the tide is taking out all the boats right now. Is that the
understatement of 2024?
Yeah, well, it lasted for a great 3 weeks. It was fantastic. But, Stanley is not going to be very happy this morning. I still think there will be a nice opportunity year-end for Russell. Once we start getting into this cutting mode, we are in a cutting cycle. That is known.
So what does it take to get the Fed? If we don't have as it were, a cut in between, what does it take to do 50 in September?
Well, I think 50 is on the table for September. And Jay Powell, I'd be shocked if they did do an intermediate cut. The last time they did that was COVID. I don't feel like this is a COVID emergency right now. It stinks, but no. So I think watch Jackson Hole, watch some of the Fed speakers over the next 2 weeks going into that. Jackson Hole 2 years ago, if you remember 2022, he threw cold water on a rally when he said he was raising rates. He can do the exact opposite this year and say, all right, we know we need to cut. We didn't expect unemployment to accelerate as much as it did, and they're going to take the necessary measures, watching each data point one at a time. They'll go back to his boring little narratives. He's never going to panic, and I don't think we're going to get a cut until September 18th, unfortunately. But when he does it, I think 50 basis points is on the table, and he will orchestrate that and tell us step by step how he's going to do it because he doesn't break from script.
Do you think market participants are more inclined, to take risk rather than hide? In other words, deploy rather than run? Because I'm seeing haven in FX, in yen, in Swiss, and in rates. So I just wonder, can you wrap it up in a day and sort of say, look, today, Manus, this is the low point. It's a realization.
No. This will take time. This will take several weeks, and I think Jay Powell
of high volatility. Several weeks of high vol.
Hey, high volatility. The traders at the exchanges, they're very happy today because they're going to get some extreme volatility. That is a good thing for someone looking at the portfolio. Just put it away. Watch something else.
Don't look at the valuation.
No, don't. But like I said, just be smart. Look, nothing fundamentally has changed. That NVIDIA story about the chip delay, okay, that has me worried. But when you look at earnings, we're still getting earnings growth. We're still expected to get further earnings growth, especially in the small caps. So that's why I think the fourth quarter, we'll see them come back. But nothing has fundamentally changed from today to yesterday. Powell just missed an opportunity to cut last week, and the market is telling him you screwed up.
Well, he's being punished quite brutally. Jay, thank you so much. Context this Monday morning, Jay Woods of Freedom Capital. Again, across the equity markets, as Jay has just said, it perhaps is an opportunity for you to think about this. You're looking at us bouncing from our lows. We were down 6.5% at one juncture. The NASDAQ is now down 4.49%. Volatility, by the way, is at a 4-year high. So, this is going to be a bumpy ride. In terms of the differential of what comes from the Fed, JP Morgan and Citi are now talking about a 50 basis point cut. So equities are under pressure, and the Russell really taking a beating this morning, down 4%. So that just shows you some breadth on the market. So there's a 60% odds of the Fed cutting within a week. Is that real, or is that just panic reaction in the short end? Good morning from New York. Bloomberg Brief, I'm Manny Scranny in New York. It's Monday morning. Politics also top of the ticket. The Vice President Kamala Harris is nearing the finish. The presumptive Democratic nominee met with a short list of 3 potential candidates on Sunday and spoke with a few other contenders as well. According to people familiar with the matter, let's get to Kriti Gupta. She's been tracking the political story for us. So, look, Shapiro has been the hot name over the past number of days. Is the pack narrowing? And is he rising, or is it split odds at the moment? Kriti, good morning.
Good morning, Manus. It is kind of a split, and I would originally say a 3-way split, but there's still some other names that are kind of seeping into the narrative. Remember, on August 7th, by August 7th, Kamala Harris is expected to be the Democratic nominee by virtual roll call. But some of the names we're considering, you mentioned Josh Shapiro as the favorite, others as well. Mark Kelly over in Arizona, a major swing state. Then you have Tim Walz over in Minnesota. But then, Manus, you also have names like Andy Beshear, for example, who's the governor of Kentucky. He's been very vocal on the labor front and earning the endorsement, the backing of the UAW president, Sean Fain, as well. So this is a really big story about not just finding a white male centrist to kind of balance out the ticket from Kamala Harris, but also finding someone who appeals to the larger kind of labor movement that you're seeing take shape in the states.
And I suppose the question is, you know, there's been a lot of debate over the weekend about the parameters or the guardrails that might be set up over a on-stage debate between Harris and Trump. So where are we going with that? How important is that in the evolution of this campaign? Because both sides have been chiding one another, to say the very least.
Well, it's very important. And remember, this comes in the context of CNN actually being able to secure both Joe Biden and President Trump on one debate stage, but also ensuring that things like live mics or mic muting, for example, was going to have live fact checking was off the table. So these are things that now I believe ABC is going to be moderating or attempting to moderate the September 10th debate if President Trump does agree. But this is going to be something that takes place in the way that they really deliver or execute, I should say, the debate. And fact checking is a really big part of that. Having a potential live audience is another part of that. The CNN debate didn't have that either. And that is a real departure, Manus, from the norms from the political space when in the lead up to the election.
Kriti, thank you very much. It's going to be a hot week for politics and markets. They are colliding at a vicious rate. Kriti Gupta there in London. The bond market is ground zero for growth scare concerns. Equity markets have taken their lead from that. You've got stocks down 2.7%. The Nasdaq was down 6.5% at one juncture. Apple and Nvidia have also taken a brutal push lower this morning. Nvidia 20% lower from its peak. Julian Emanuel debates whether it's an air pocket or something more malevolent. This is the bond market. 10-year government bonds crashed 40 basis points last week. You're down a further 5 basis points this morning. You're looking at not just a narrative going from a soft landing, but almost Peter Cheer over at Economy talks about holy recession Batman. And that is, you know, the tail that's wagging the global dog is the U.S. market in terms of a growth scare and a central bank which is behind the curve. German yields down, as you can see there, another 5 basis points, and likewise in the U.K. So the narrative will build not just for faster and more aggressive rate cuts from the Federal Reserve. JP Morgan, along with Citi, talking about 50 basis points now, but traders pricing in 60% odds of a Fed cut within a week. On Friday morning, we speculated that there was a tiny percentage possibility of a rate cut between now and September, and that's blown out to 60%. Money flows into the havens of yen, of Swiss, of bonds. The short end of the curve is getting crushed. Coming up, we'll set up the agenda for your earnings and the Fed speak. What will the jawboning be about rates? That is the definition of intervention from the Fed. Good morning from New York. It's Bloomberg Brief from New York with me, Menace Cranny. A check for the rest of the week. San Francisco Fed President Mary Daly speaks at 5 p.m. Eastern today. So let's see what the beginning of that pushback from the Fed looks like and sounds like. Earnings continue with Disney and Novo Nordisk reporting on Wednesday, and more Fed speak to come. Richmond Fed President Thomas Barkin speaking on Thursday. Traders are now pricing in a 60% chance of a Fed cut this week. Simon White joins us now. It's interesting, Simon, we've gone from a slither of that being a risk to a 60% possibility. How real is that? Because this is not the GFC, this is not COVID, this is not March 2020 when the Fed cut by 150 basis points. Is this a small risk play or a real risk play?
It's certainly the distribution has changed, and in markets that's what matters. So outcomes obviously ultimately matters, but right now the distribution has changed and the market is reflecting that change of distribution. So the Fed, its main aim of obviously its official mandate is inflation and unemployment, but really what it comes down to is it's really trying to prevent these negative feedback loops developing between the real economy and between markets. And what's happening now, we're in that reflexive mode where all of a sudden things are moving considerably faster. So, the economy last week, today, they're very little different, right? Nothing has really changed there. Although you will get people saying, see, I told you so, recession was definitely going to happen. What's really changed is the market, through positioning, has begun to price in much higher chance of a recession, but that's precisely what makes it more likely. And that's why there's going to be extra pressure on the Fed to act. And that's not to say that's the right move in the longer term. That's throwing more fuel in the fire. But the reality of the situation is the Fed is in a sort of invidious position, right? Because if it does nothing, it will get a lot of opprobrium for, maybe not preventing a recession. And if it does do something, it'll get accused of pandering to the markets. But when it comes to this percentage that you're talking about, I think it's actually a little bit lower now. It's more like 20-25% of an early cut. But the problem is, if you do get an early cut, by the way, it's unlikely just to be a 25. They're probably going to do something bigger. So again, your distribution has changed and your risk reward is really swung in favor of taking that outlook. Because if you're wrong, your downside is very limited, but if you're right, you have a very big upside.
It's very interesting, the reaction function. Yeah, I'm not saying there's not a bad reaction function in the US equity markets, down 6.5% at one juncture on the NASDAQ futures, Nvidia down 20% from its high. But when I look to the Asian markets, Topix and the Nikkei tumbling by more than 12%. The Topix had its biggest drop since data going back to 1959. Now, part of that is yen strength. That's undoubted. The speed of the move in yen, I think, is adding fuel to the sell-off in the equity fire in Asia. Is that a correct assessment?
Absolutely. I mean, look, the Bank of Japan keeping rates ultra low when everyone else was tightening has allowed these imbalances to build up. I mean, the Bank of Japan's got a very large balance sheet. Yep. And that's really been the powerhouse behind this carry trade. So look, people have been talking about this, obviously, for as long as it's been going on. Nobody can tell you exactly when the kind of last bit of sand causes the dune to kind of fall apart. But you kind of know the direction things are going. And Bank of Japan raising rates on Wednesday was really the kind of last straw, I think, in that game.
Simon, thank you so much for context this morning as we go into the surveillance 3 hours. They'll take you through the rest of the risk in this market. Volatility is spiking to the highest level that we've seen in 4 years. The consequence of that, as the US hits their desks, is that we're heading towards some kind of a pretty tough landing. Bond markets rally.